continue. Okay, so my name is Tevra Francis of NJ in Color, formerly Bergen in Color, where we connect to the diversity of North Jersey. And we are here today because this is Financial Literacy Month. So as the month closes, we wanted to have something that we, there's not anything that we really wanted to have a set structure or anything, but this is not a formalized meeting. We just wanted something where people can get information, you can ask questions, we can talk about money, because in this community, we need to have more conversations surrounding money and how to save our money, how to grow our money, how to, things like fixing our credit or getting the right types of insurance or the right types of financial products that are going to help help with our goals in the future. So what we want to do is provide an opportunity for just everybody to feel, no pressure, no question, no sales, no anything, just questions and answers with professionals who are local, that you can see them in our local area. You can contact them directly, and we just want to provide an avenue for a dialogue within our local community with those who are professionals and those of us who are not, like myself. Again, my name is Tevra Francis, and being that I have the type of site that I do, people ask me questions about some of everything. And if you knew how ignorant I am as far as finances, you would be shocked. And my husband is sometimes appalled at how ignorant I am as far as finances are concerned. So, so when I get questions along these lines, it's like deer in the headlights. I don't know, but I know somebody who does. Let me just point them to this direction. Or hey, and we've done it a few times where I give somebody the name of someone I know and they become a client, or at least have somebody that they can ask a question to as far as the issues that they've been having. So instead of doing this on a one-on-one level situation where if you have my phone number, I can point you in a direction, I want to be able to do that for the greater community, the greater network, and just show you guys that there are people in our community that can help you. And knowledge is power. We are all in this together and people can help. So with that, I want to introduce you to David Carler of Northwestern Mutual and James Brown, certified public accountant well, David is of Paramus. His offices are in Paramus, and James Brown is in Teaneck, Teaneck, right? Yes, Teaneck.
You are correct, yeah.
Yeah, so both in Bergen County, but like I said, this is for Northern New Jersey, and everything is drivable. Everybody's accessible online. And so don't let location stop you from getting the information. It's valid anywhere. So I want to start with David. David, can you tell us a little bit about yourself and about your offices and what you do?
Thanks, Tevra. First of all, I think I love this platform, this NJ in Color platform. It's a good place to house some valuable information that the greater community needs. So kudos to you for putting this together. And obviously, it's always an honor to sit next to my guy, James Brown. So this should be a good conversation. I've been in financial services for about 18 plus years, started my career in commercial lending on the institutional side at GE Capital. About 10 years in, I transitioned to personal wealth management. So I started my personal practice here at Northwestern, let's say the past 6 years, focusing on holistic planning, not so much transactional, not too much product pushing, but more holistic planning, dotting all the I's, crossing all the T's, making sure we're efficient as possible. I think that's that graduated level of finances where, in the beginning, everyone's buying a product. Someone told them about something, they're buying this, they're buying that. I think financial planning is how you put it all together and tighten it up and make sure the left and the right are complementary and make sense. And obviously tax efficiency is a big theme, is a big part of the conversation. And hopefully James can shine a light on that today as well. But that's my focus. That's my passion, holistic planning, not so much product driven. I think that's the best way to go. We think long-term. There's no such thing as a magic bullet. That's my philosophy, right? You need a little bit of everything. And that's me in a nutshell.
And James, can you tell us about yourself?
Sure. As you said, my practice is in Teaneck. Also, a couple of years ago, we also had offices in New York. That became no longer financially feasible, so we shut that down. So I'm based strictly in Teaneck now, but interestingly enough, my practice is basically nationwide. I have clients in California, Oregon, Texas, Illinois, Georgia, North Carolina, South Carolina, and some of those clients even work in multiple states. I have a client who's a basketball referee, so I just found myself having to add the Utah State module to my tax software a couple of weeks ago. But I've been in the accounting business, or the tax game, as some call it, for quite some time. I sometimes get a chuckle when I get a call from a prospective client, and they're kind of interviewing me, and they say, "Well, how long have you been doing this? How long have you been doing tax returns?" And, I can often, by conversation, I can pretty much gauge the age of the individual, and I'll sometimes say, "Well, probably longer than you've been born." I started my practice on a part-time basis, evenings and weekends. I graduated from Fairleigh Dickinson with my bachelor's degree in accounting, and of course, everyone who knows that you're an accountant automatically associates that with income tax preparation. So people started asking, "Can you do tax returns?" And, like, sure. So that grew over the years, and then finally, about 15 years ago now, as what I didn't mention is, throughout the time, I always maintained a full-time 9-to-5 job in the corporate arena, and maintain the tax practice, as a side hustle, as they say. But over the years, it grew and grew. And then in 2007, my employer informed me that my services would no longer be necessary. So Plan B became Plan A. So it was an interesting transition. Like I said, it was always a side hustle, and it was good for extra money. Vacation, make major purchases, put in savings, and then now it became pay the mortgage money. Save for college money, things of that nature. So it's been an interesting journey the last 15 years. But as I look back, I now say that I could never ever see myself working for someone else again. So my focus, my practice is heavily tax based, but I do perform other services, accounting, consulting, a lot of business advisory work. So pretty much everything that you might expect a CPA to do, other than audits. I don't do audits, but I do have colleagues that I refer those out to.
Great. So for those of you who are just joining us, this is Money Talks. Thank you for joining us. My name is Tevra Francis of NJ in Color, and we are talking with David Carler of Northwestern Mutual and James Brown, CPA. And this is just a conversation about money. So if you are interested in having any questions answered, now's the time to go ahead and start adding them to the chat. We're going to start taking questions in just a minute. I'm going to go ahead and start with the first set of questions. They just went over their backstories, if you will. So we're going to go into a little bit of Q&A. So David, we're going to start with you. So I saw you at an event over the weekend, and we talked a little bit about estate planning. And you had so many questions from the room. What are some of the most important things, if you can do it in like a minute, the most important things people need to be cognizant about when it comes to estate planning? If you can do that in like 1 to 2 minutes, what are things that people just need to like kind of have in their knowledge base?
The first thing I'd say is just as much as, handle as many things as you can handle without leaving it to the courts. So that's one idea or one philosophy I have. That's simple, right? Making sure life insurance policies, you have your beneficiaries updated, making sure 401ks, you have your beneficiaries updated, even non-qualified accounts, checking accounts, savings accounts, you have the PODs attached to them. If it's investment or brokerage accounts, you have them titled, appropriately, transfer on deaths, your TOD titling, making sure assets are owned the way you want them. So, joint accounts or joint deeds, joint titles versus solo. Have conversations with family members, right? So there's, people know what to do. And, you don't want to start thinking of things in the middle of a crisis. You don't want it to be gray, right? It's already a stressful time when we're at the end of life and beyond. So I'd say have conversations early. It's never too soon to start estate planning, and inventory. I can't tell you how many times when I meet someone or a family, oh, I think I have something over here, just casually, I'm not sure what it is, find out. Because like I always say, there's no such thing as no estate plan, right? If you don't do it, the state will do it for you. But so estate planning will happen whether you like it or not. It's better that you have control. So I'd say just be cognizant of, your scenario and have conversations, even things like, designating a guardian for your minor children, if that's the case. That's very important. So yeah, just have conversations. Healthcare, what do you want to happen at the end of the road, healthcare wise? Talk to your loved ones. Don't have them trying to figure it out at the end in the middle of a crisis. So plan for the end of life and beyond while you're still healthy. I think that's a good 2-minute snippet right there.
And I think that's valid for regardless of income level. I think when we think estate planning, we think of having a huge estate and millions of dollars, and this is not relevant for those who don't have that. No, it's relevant for everybody, because we all know how it is when there is no plan and someone has passed on, and how traumatic it can be, how it can break up families, how when Big Mama dies, and how it's just a hot mess sometimes, or the GoFundMe campaign, at the last minute. So we want to be able to help give information so that you don't have to do that. Even if you don't make $1 million, even if you don't make $50,000, there still needs to be a plan in place for the inevitable, because we all are marching that way. But not to start out morbid, but that was the one thing that stood out to me when we had that session on Saturday. How many questions you got during that portion of the event. So James, I'm going to skip to you. So one of the questions that I have is for small business owners. So we just got through tax time, and for small business owners, we have a lot of us, well, let me not say a lot. Many of us have the fortunate issue of making money but not knowing how to allocate payment to ourselves. And how does that fall within like our tax purposes and receipts and all? Can you explain just an overview of how do we do that without
Sure.
running afoul of the IRS?
Right. So I was going to say you won't run afoul of the IRS by paying yourself, but that's not necessarily true. So it really revolves around the entity type that you've chosen for your business. So if you are a sole proprietor or a single member LLC, which is the same from a tax standpoint. That's another thing a lot of people don't understand. They think that forming an LLC as a single member organization changes your tax status. It doesn't. A single member LLC, in fact, is what is called a disregarded entity for tax purposes, because it's treated exactly the same as a sole proprietorship. So basically, what you want to do in that scenario is take draws. And that can be, it can be a regular amount. You can pay yourself, $500 a week, let's say, or you can, take the draws as necessary, as money's needed to pay bills, or what have you, you can move money from one account to the other. Preferably, what a lot of people do, which they shouldn't, is they'll pay personal bills from the business account. And you should always have separate accounts for your business as opposed to, commingling with your personal account. So that's how you would pay yourself in that scenario. But you also have to be careful. You have to understand that anytime you're paying yourself, that you're paying yourself out of profit from the business, right? Because people will pay themselves, they move money, even if it's just to pay expenses, right? To pay rent, to pay a car note. And they move that money, and at the end of the year, they have a tax liability. But there's no money in the account, in the business account or the personal account to cover that liability. And they're like, well, I don't understand how I could owe $20,000 in taxes
because you've been eating into that $20,000
right? Because they're looking because there's $50 in the business bank account. They're looking upon that as though, oh, okay, I only made like a $50 profit. No, all of that money you took to pay yourself or to pay your personal bills, that came from personal profit, from business profit, which is personal income. Now, if let's say you're an S corp, right, and you can be a one member, a one shareholder S corporation, that comes with a little different responsibility in terms, excuse me, of how you pay yourself. Technically, as an S corporation, you're required to pay yourself what's called reasonable compensation, and you should be on payroll. And you set up a payroll, and again, that can be a weekly amount. It can be monthly. You can even do it one time at the end of the year, but you're supposed to pay yourself, withhold the appropriate amount of Social Security and Medicare tax, and have the business match that. Because what happens, not to get too technical, but with an S corporation, the corporate earnings themselves aren't subject to self-employment tax. And self-employment tax is the employee and employer portions of Social Security and Medicare, which as a business owner, you're required to pay both pieces. So as a sole proprietor, you would pay both through what's called a self-employment tax. As an S corp owner, you would withhold it from the salary that you pay yourself, and then the business would match that. So that's how the two parts get paid. So what happens is a lot of people fail to put themselves on payroll, and they wind up not paying that Social Security and Medicare tax. So that has a couple of implications, right? One, if the IRS comes in and audits you and says, okay, for the last 10 years, Jason Murray hasn't paid himself from his S corp, and therefore hasn't paid any Social Security and Medicare taxes. So you're going to go back, you're going to pay all of those taxes, Jason, but guess what? We're going to charge you penalties for not complying with the law, and we're going to charge you interest for all the time you held that money that was rightfully ours, belong to government. And the other thing, which, a lot of people don't really think about, that's in that scenario I just gave, that's 10 years that you haven't contributed to Social Security, which ultimately, is probably going to affect your benefit when it comes time to collect. And so that's the S corp scenario. And in partnership, you typically have what's called guaranteed payments to partners, and that can either be for services rendered or for capital, depending upon the partnership agreement. And those, again, are periodic payments that come out to the partners. They can be in equal amounts to every partner. Let's assume there's two partners. They could each take $25,000 a year, $50,000 a year, and then whatever profit or loss falls to the bottom line after that expense is recorded, that because that's recorded as an expense of the business, as opposed to, say, a sole proprietorship where you're taking draws. So let's say the business made $200,000, each partner had $50,000 salary, there were $50,000 other expenses, so $150,000 in expenses in total, so $50,000 profit. So again, that $50,000 profit would be split equally among the two partners, assuming a 50-50 split. So that income would also flow through to the partner. So it would be a combination of the guaranteed payments plus the earnings from the partnership. So in that case, that would be, I guess, like $75,000 each. And those are all subject to self-employment tax, the Social Security and Medicare. So, it really heavily revolves around the type of entity you've chosen. And also, you have to be mindful of how much money you need to take care of your personal responsibilities. And you don't want to strap the business, right? From an operation standpoint, you want to make sure you have enough cash flow to continue operating the business.
Okay. So anybody have any questions so far? If you have any questions, you can feel free to raise your hand or you can type it into the chat. I have another question about S Corp versus LLC, but let me go back to David real quick and then we'll come back to you, James. So Dave, you talked about the different types of, you had a diagram about the different types of ways to invest your money. Am I correct? Can you go into that diagram that you had, the different buckets that you can help me?
Great point.
You remember the slide I'm talking about? Okay.
When we're accumulating assets, when we're in that accumulation phase pre-retirement, a lot of times the focus is on diversifying in investment asset classes, right? The right mix of stocks to bonds to maybe real estate to cash, whatever it is. But oftentimes what gets lost is the tax diversification, right? So it's good to have some tax deferred stuff, some tax-free stuff, money, right? When I say stuff, some tax-free buckets, some tax deferred buckets, some tax buckets, because when you get into retirement, you want that option. And this is where planning, we don't get caught up in what's going on in current day because we know we're prepared for any scenario, right? If you're in a low tax rate environment, you don't mind pulling from, taxable accounts or those accounts that were tax deferred. You don't mind pulling from them. If you're in a high income tax rate, we're in a high tax environment. Luckily, hopefully we have some cash, some tax-free buckets where we've accumulated some assets. So we have the option. So let's say, to give an example, a family wants to live on 10 grand a month in retirement. They don't want to have to drain, 17 grand in assets to get to that net 10. Maybe with the balance of some tax-free cash, some taxable cash, maybe you pull out 11 grand to get to the 10, right? I'm just using an example. It's not, So the point is you want to dilute that tax impact in retirement by having options. So, and you can't wake up at age 65 and have those options. You have to start, preparing that now. You have to start watering the grass today. So when I'm sitting with clients, obviously we're talking asset diversification, but we're also talking about tax, the tax implications of the different buckets. Everyone have access to the Roth or, obviously the Roth limits are a little lower than, your 401k limits, your traditional 401k limits. So, it may be a struggle for some, but just be conscious of the different tax buckets as well, right? It's good to be diversified from an asset standpoint, but let's go a step further and make sure we have some tax diversification also, whether it's using the insurance policies or some tax shelters, using the Roth bucket. Obviously, when we're investing, right, making sure, municipals come into the conversation and so forth, ETFs versus mutual funds. We're doing everything. We want to tie that tax efficiency thread throughout the whole plan. Everything we're doing, because it's not about what you make, it's about what you keep. So you always want to have that in the back of your mind. How much of this I have to give back to Uncle Sam in the end. So I think that's the diagram you were referring to. We had your non-qualified investments, your 401ks and IRAs, your Roth money. We had cash value life insurance in there. You have your Social Security pensions and maybe some other annuity, right? So you want to dilute, have different types of taxable assets at the end.
Okay. Any questions so far? Okay. James, going back to you, do you have anything to add to that part, James?
Yeah, I think they've captured it pretty well, but again, the diversification is key. Back, when I started working, first of all, there wasn't no Roth IRAs or Roth 401ks, but the whole concept was to put as much as you could into the tax deferred bucket because the assumption was that you would be in a lower tax bracket in retirement than you are, during your working years. And that's not necessarily the case nowadays. People have built significant retirement nest eggs, and now with the way the market is nowadays, a lot of times towards the end of your working years, which was typically your most productive years, people are forced to, they've been laid off, they're forced into lower earning jobs. So the last 10, 15 years of your career may be significantly lower than what you earn in retirement. So it's important to have a good plan in place so that you're structured properly in terms of diversification.
Okay. All right. So here's my question regarding the LLCs versus S corps. So a little bit of disclosure. I set up my business as an LLC, and then you know how people talk. Somebody told me that I should have set it up as an S corp. I don't know. So what types of businesses do better under LLCs? What types of businesses do better under S corps? And what is the difference between the two? Because a lot of the people that I know, we're just starting out. We don't know the difference. They say start an LLC to get an EIN. That's what we did. We don't know the difference between all of that other stuff. So can you just kind of break that down for us who are
right? So there's no, as with most things, there's no one size fits all answer to that question. It really is based on what your goals are of the business owner, how profitable the business is, how disciplined you are, right? Because I'll give an example. A number of years ago, I acquired a client in the entertainment industry. So I had a colleague who, had a significant niche in that market. So I called him. I was like, how should we set up the business? He was like, every entertainer, and this is not the stereotype, but this is what I was told. He said, I automatically set them up as an S corp because as I alluded to before, as an S corp, you're required to put yourself on payroll. So that instills the discipline for you, right? You don't have to worry about paying estimated taxes, which a lot of people don't. And this is not my opinion, but according to the colleague who I spoke to, people in that industry sometimes are not so diligent about doing that. And it becomes difficult, right? Because the money sometimes comes in chunks. Like if you're in the recording industry, you might get an advance for $100,000, and taxes are the last thing on your mind. By the end of the year, that advance is gone, but you have $100,000 in taxable income. So here's the primary difference. In LLC, as I said before, you're responsible for paying both the employer and employee portions of Social Security and Medicare, and that's going to be based on your entire net income. So if you have a bottom line of $200,000, you're going to pay Social Security on the first, 140 whatever thousand, and then Medicare tax on all of it. Now, if you're an S corp, let's say Tevra's an S corp, she decides to not necessarily change her entity status because as an LLC, you can elect to be taxed as an S corp without filing for a new business form. But now you say I want to be taxed as an S corp. So as an LLC, you were making $200,000, but let's say you sit down with your accountant, you determine that reasonable compensation, and there are a number of considerations that go into what really constitutes reasonable compensation. So you have to be careful about that too. That's another myth that people have. You say reasonable compensation for someone doing this type of work in this type of business is $100,000. So you're going to put yourself on payroll for $100,000, you're going to call it ADP or whatever, and they're going to withhold federal and state income taxes, and they're also going to withhold FICA tax, which is Social Security and Medicare. And as a business owner, the corporation will also file quarterly tax returns, paying over the money that was withheld, but also paying the employer portion of those taxes. Now, the other $100,000 is still going to be profit, but you don't pay the self-employment tax on that. You just pay the state and federal income tax. So that's one of the tax saving opportunities that most people are talking about when they say, oh, you should be S Corp. But again, let's assume you have children. I have one client that has 5 children. She put all of her children on payroll, right? That moves that money from her tax bracket, which was high, to their tax bracket, which was 0 for most of them, right? And you can plan to keep it at 0 or at very low tax bracket. And then you could really get fancy. You can turn around and take their money and put it into an IRA and start them, because they had earned income now. So she can do that as an LLC, right? Well, let me further clarify. One of the benefits of putting your children on payroll, not only you're moving that money to a lower tax bracket, but if it's a minor child, they're not subject to Social Security and Medicare, right? So you can do that as a sole proprietor or a single member LLC. However, if you're a partnership or an S Corp, you can't do that because it has to be a child of the owner. So if you're a multi-member LLC or partnership or an S corporation, that entity is now the owner. So that's not your child. That person has to be treated just as every other employee is. So you're going to pay that Social Security and Medicare. So, I say that just to illustrate that there's not necessarily a one size fits all answer. And you also have to be careful. Like some people, try to play games with the reasonable compensation. If your business is making $1 million, you're the only person that's working in that business, and you say, okay, reasonable compensation for me is $75,000. And that could be, but if the IRS comes in and looks at that, you're going to have to substantiate, how you came up with that reasonable comp number, because basically there's 3 ways that a business makes money, right? It's through the efforts of the owner, the efforts of other people, and through machinery and equipment. So if you're someone, like I have a client that owns a temporary employment agency, and she's an S Corp. So she can very easily justify that a lot of the money that falls to her bottom line is through the efforts of other people. So therefore, her reasonable compensation number could be somewhat low, as opposed to someone, let's say like me. Basically, all of my income is generated from my personal effort.
Okay.
So if I made $1 million, which I don't, and I say, well, only 50,000 of that is reasonable compensation, and I'm not going to pay FICA tax on the rest. They might look at that a little differently. So again, you should consult with your CPA. Make sure that whatever plan you have, whatever entity type you choose, works for you.
Okay, so we have a question with regards to LLC. So what about an investment property with 2 owners? Should that be under an LLC?
I would say yes. The thing with investment properties, what the LLC does is it shields you. LLC stands for limited liability company, right? So it shields you from personal liability. So if something happens in that investment property, and not only if it's 2 owners, even with 1 owner, you want to shield yourself as an individual. You want to put that property in an LLC to to limit your personal liability. And to go a step further, if you have multiple properties, you want them all in separate LLCs, because just as you want to shield yourself from personal liability, you want to shield one property from something that may happen in another property. Let's say you have 3 properties and they all have the same ownership, right? Something happens on property C, which basically has no assets. You know, if you sue them, you're not going after anything. But now they can go, if they're in the same LLC, they can also go after any other properties that are under the same management. So yes, I would say you probably want to go to the LLC. All of my real estate investment clients have, if they're multiple member, they're in LLCs, and most of the single owner clients are in LLCs also. And if they're not, I strongly encourage them to do that.
Okay. Hope that helped that person that asked that question. So Dave, I have a question for you. And this is going to be a long one because each of us on this call, or whoever's going to be watching in the future, this is going to be on YouTube later. So if you want to go back to watch this over again,
I would have put my makeup on if I realized.
We need to get you some blush. So this is going to be on YouTube later, and we'll send that out. So each of us have our own, I guess, we're all at different stages in life. So I'm in my 40s. I just had a child. Some of us are in our 30s. Some may be younger watching. Some may be older, headed towards retirement, in retirement. What are some of the things that, if you can group us into like young adult, middle age, and retirement age, what advice do you have for each of those categories as far as what we should be doing as far as like our financial outlook?
Gotcha. The beauty of financial planning is, it may be complicated, but it still is pretty simple, right? So there's still three areas we need to address, no matter where we are, right? It's going to be risk management. That's how do we into all the things that can go wrong. So your life insurance, your disability insurance. Maybe if you're a little older, we're talking long-term care planning, right? Cash management. That's all risk management. Phase 2 of financial planning is the accumulation phase. That's the 401ks, the IRAs, the brokerage accounts, anything you're doing to accumulate resources. And then phase 3 of the plan is distribution. How do we tap into our assets that we've accumulated? So different stages of life, you're going to be doing different things, but within those areas, right? So a young professional who has a long runway in front of him or her when it comes to income generation, maybe disability insurance or disability planning is important because your most important asset is your ability to earn income. So maybe that person is thinking disability, pretty heavily. Maybe someone 50 plus doesn't care too much about disability planning. Long-term care is the top of their mind, right? So we're talking long-term care, usually over 50. We want to start putting a plan in place and obviously, again, having conversations with the family because everyone's plan is going to be different. In that accumulation bucket, I can't tell you how many people I meet, in their 40s or even 30s, and their 401ks are set super conservative, because they think it's a personality trait that we're measuring, right? So they say, yeah, my 401k is conservative, right? We need to address that. Not that that's wrong because everyone's different, but we need to make sure we discuss how did you come about with, an account that you cannot touch for 30 years or so. Why is it going to be set so conservative and you're leaving returns on the table, right? So are you truly conservative? Are you moderate? Are you aggressive? Whatever that is, we need to have that conversation. It's not just a personality trait, set it and leave it alone, right? Obviously, when you're when there's younger children involved, life insurance is a big part of the conversation. College planning is a part of the conversation. Later on in life, not only is asset allocation, as I kind of touched on earlier, important, and not only is tax diversification important, but asset location is important now. So how we invest inside of the 401k and the IRA, should that be different than how we're investing outside of that in, let's say, our brokerage account, right? Maybe capital gains tax is more attractive than ordinary income tax, right? Well, not maybe, it is, but what is the plan around that? So these conversations need to be happening at different stages. So I would just say, and that's the purpose of planning, right? Because we map all of this out. When you're transactional, you miss a lot of these conversations, right? You go in an office, they show you a pie chart, say, yeah, our product did 13% last year. Woo, buy it, and that's it. That's not planning, right? 30 years from now, you won't care if that product was 13%, 9%, 8%. What you will care about is, was I allocating the right monthly amount to which bucket? That's going to matter later on. So we all still have the same three areas, right? Risk management, wealth accumulation, wealth distribution, but the subcategories are more or less important depending on your family's priorities, what's important to you, and so forth. So just having that conversation, I think, is the most important thing, right? Because, like I said, your neighbor's plan could be totally different from yours, and that could be fine or that could be awful.
Okay, I have another question for you. Okay, so we all understand that investing, it takes a lot, but what if somebody just wants to get into investing? They only have, say, $1,000. It's about to be tax return time. What if they want to just get their feet wet and say, okay, well, I don't want to be, I am conservative. I don't want to do too much. I only have but so much to spare. What is your advice to that person who does not want to, jump in with both feet, or they don't have a large sum, they don't have 100 grand or even 10 grand to get started, but they do want to get involved in investing to just test the waters and see if it's, something that they can handle? What do you suggest for that person?
Well, now, since we have limited dollars to go around, we still be as diverse as possible. That's where, your mutual funds or your ETFs come in handy. When I say mutual
funds, what's an ETF?
Exchange traded fund. So it's similar to the mutual fund concept as far as it's a basket of securities. It's not one, right? If you only have, $100, you can't buy 500 stocks, but you can buy a mutual fund that has 500 stocks in it for $30 a share, right? Okay. So that's exposure to a lot of assets with limited resources. And obviously, as you grow and grow, we can start divvying it up more. Maybe we get 3 mutual funds, then we grow to 5. Then you put a portfolio together, right? Mm-hmm. So you can start small. There are no minimums. Some people often think, I don't make enough to do investing. You can invest.
That's the common thing why we don't get involved, because we don't feel like we have enough to start. Yeah.
Start the conversation around your budget. Figure out your cash flow. Make sure we can be responsible, right? You don't want to allocate everything to one bucket. You don't want to say, let's say you spend $4,000 a month, you take home $4,800 a month. You don't want to take the whole $800 surplus and dump it into a mutual fund, right? So you still want to be responsible. I need some emergency funds. I need some, whatever my insurance needs are. And then I have a portion that I can allocate to investments every month. So find out that budget piece first, and then we can start diversifying and growing that portfolio slowly. You're not going to change overnight, but we're going to set goals, right? A year from now, what can you expect? That's what financial planning is, right? 5 years from now, what can we expect? 10 years from now, what we expect, and so forth. So put a plan in place. Like I always say, if you're behind in the third quarter of the game, you don't just go home. You still got to do something, right? Mm-hmm. So, put a plan in place for someone who doesn't have a lot of resources, but you still put a plan in place and you go. You don't just take your ball and go home in the third quarter, right? So we can all start somewhere. There's no minimum to start planning and start investing and start saving.
Okay. So we have a few more minutes left. So I have a question about the hot thing has been cryptocurrency, Bitcoin, Dogecoin, NFTs, all those T's, all that digital in the cloud currency. Now it's being taxed, apparently. I don't know how any of that stuff works, but I know it's there. And I know that people are very interested in it. I'm not sure. I have not gotten involved in it at all, but I think it would be, you kind of have to have your head in the sand if you don't, see what's going on out here, as to what, the popularity of it and how it's grown so much and so fast. So I want to just get your thoughts, both of you, on what are your thoughts around cryptocurrency? How do you, not to say deal with it, but have you come across like the tax implications? Do you have it? What's it like? Like, just explain your thoughts about the whole cryptocurrency situation. right now? I'll start with James.
My thoughts is kind of like anything else, right? Approach it with, this is my thoughts, my personal approach, and maybe it has something to do with my age and the stage of life where I'm at. Just approach it with trepidation, and make sure you understand it, because I'll be honest with you, there's a lot about it that I still don't understand. Like I'm reading books and stuff, and I really got into it at just following my sons, because they both got into it. They're 20 and 24, and I sort of dipped my toe in the water. I haven't gone there. I'm not, as you can see, my body's not wet yet.
In the crypto water.
Yeah, it's obviously, I think it's here to stay, but like anything else, like I have a colleague who's roughly my age, a few years younger, told me he's going to try to get his salary paid in crypto. I was like, why would you do that? He's like, well, it's like the stock market, it's like investing in stocks. I said, so would you take your whole salary and dump it into the stock market? Right? Because the thing about stock markets or cryptocurrency is it can go up or it can go down. And if it's down at a time where you need to get out, if you have some liquidity needs or something, you can have a problem, especially if your entire salary's in it. Now, there was a story, the football player, Odell Beckham Jr., where he allegedly got his entire salary for the year paid by the Rams, he got it paid in crypto, right? I think that was like $750,000. So by the end of the season, the particular currency had dipped significantly in value. And it was I don't know if it was worthless, but it certainly wasn't worth what, the cash would have been, what he initially invested.
Mm-hmm.
And so that's a double whammy, right? Not only have you lost money on that investment, but he's got to pay tax on that entire amount.
On the initial amount, he has to pay tax on that, he doesn't.
That's wages. The government doesn't care that you took it and gambled, in a volatile instrument, and the cash is no longer available. So, I don't know if that story is true, but I would certainly be hesitant, as with anything. It's like, as David alluded to earlier, you need to diversify. So certainly, even at my age, like I said, I dipped my toe in. I've listened to I listened to speakers who said, which is also very important, that some of the currencies he thinks are here to stay, are long-term plays. But it's like with anything else, right? When it's hot now, everybody's coming out, right? Got this cryptocurrency, got this NFT, and like anything else, they're all not going to be good, right? Some of them are going to bomb, and whoever investors are going to be stuck with them. Like I see people now, I just did a tax return the other day, and they gave me a long list of securities that they were in and out of, cryptocurrencies. And I'm like, what are you doing? $50 here, $100 there, and like selling. This is like all short-term stuff, in and out every day. So unless you have a really savvy advisor who's doing this for you, or you spend a lot of time researching this stuff yourself, that's kind of crazy to me.
Okay.
But now let's see what the professional has to say.
There's two professionals, but go ahead.
It's still speculative, right? It's like the tech bubble, right? I was going to say 10 years ago. 20 years ago, right? We know the internet is here to stay, but we didn't know who was going to be in the best position to take advantage of it. So a lot of companies went out of business. So
I thought it was a fad, personally.
A lot of people want you to feel guilty because you're not into some coin that they're in. Yeah, we know crypto's the future, but no one knows where it's going, how it's getting there. So, you still have to, you don't want to tie more than 10% of your net worth to any coin or anything like that. You still have to be diverse. You just treat it like another stock. I have clients who've made some significant returns in it. They couldn't tell you how or why they did it, right? It was like a guess. Treat it like any other security. Be cautious. Don't tie it too much to one. The fundamentals still in play here. Just, don't over rotate anywhere. Now, you can sit with the crypto experts and get the research on what coin is. I'm not a crypto expert at all, so definitely don't take, don't hold me to any crypto information. But I can tell you it's speculative. I can tell you it's something you don't want to rotate your net worth or your portfolio towards it. If you do it, that's fine. Just understand that comes with volatility. I know some people who jumped in at 60 and watched it fall to 40, right? Bitcoin. 60,000. I watched it drop to 30. I know some people who have some horror stories. So I know it's not fun for everyone. Now, yeah, if you got in that, $9 grand and it jumped to 60, you're saying you're a genius and you're smart. But that's just not everyone's story. So yeah, I would say just be cautious, keep researching, learn about it as much as you can. And in the next 5 years or so, we may know a little more than we know today. And maybe then I know Fidelity is now going to let you put it in 401ks if the sponsors okay it. So that's a big step as far as retirement accounts.
That's kind of going into the question that we have from Jason. Hey, Jason. Do you feel the financial industry will make this asset class available on all platforms? So that's kind of touching on that.
Fidelity is the number one. They're the largest. Retirement. I'd say they have the most retirement accounts in the country. So if they're now okaying putting, crypto in your 401k, I got to believe that's going to impact the market a little bit, right? It's still up to the individual companies to say, yes, we'll allow it, but it's allowed on the Fidelity's platform. So like I said, in the future, I think we may have to go that way. It's probably inevitable, but it's way too soon for me, at least, to get with 100% conviction to tell you go left or right, Doji coin, this coin, that coin. But yeah, it will be the future. It's happening right now. So just got researching.
Okay. We have a question from Tammy. People are starting to panic now with the stock market taking a daily dive. What would you tell people that want to sell their stocks for fear of losing their money?
Ooh. Well, I mean, that's what humans do wrong, right? We sell when it's low and we want to buy it when it's high, right? When the news is saying the market's great, everyone's going out to buy it when they should have already had it, right? Obviously, you're not wrong for having the fear when you see your stuff free falling, but what was the plan, right? Was this if you're doing disciplined planning, short-term money shouldn't be in the market. So if this was 5-10 year out money, if anything, you should be buying more. Mm-hmm. Now, if you're taking a gamble and you're hoping for a quick flip and you need the money in 2 months, then, you took a gamble and you probably would be losing, but stick to the fundamentals. That's why we do financial planning. You have your emergency funds, 6 months worth of emergency funds in cash in savings account, not in the market. So you're fine. This is noise. This is what we call noise. I'm not watching the market day to day, right? If something monumental happens, I'm on it, but I'm not watching, 5 days a week what's happening to Bank of America's price. Because our plan was to make sure you can retire at age, 58, like you told me, and you're going to have X amount of dollars ready for you when we get there. The model forecast every 5 to 7 years, we're going to have a correction. So we know this has to happen. So there's no surprises. It just feels bad when you're going through it, but we plan. If you sat with the plan and you plan for it, that is.
Okay. So, okay.
To the fundamentals. That's it.
All right. So we're getting on. It's 12:57 now. So we're gonna start wrapping up. So does anybody have any final questions for our panelists today, for our finance pros? Last call for questions. I think this was good. I think this was helpful. We got a lot done. Like I said, this is going to be on YouTube, and you guys can go back and watch it over again. We have a question. Okay, Rebecca, let me unmute you. Or let me see.
Oh, sorry, I didn't have a question.
Rebecca, can you hear me? We can hear you. Hi,
I
Rebecca.
didn't have a question. I was just thanking you for the presentation.
Okay.
So, yeah.
So that was you clapping. Okay.
Yeah.
Well, thanks for joining us.
You're welcome.
Yeah. So let's go ahead and start with James. James, do you have any final thoughts that you want everybody to leave with today after this session?
No, I mean, one thing, we didn't touch on, and which I think is very relevant for small business owners. A lot of business owners often look upon accounting as something that they can take care of later. May not be in their budget now. Something often they think something they can take care of themselves, and then wind up find themselves in a lot of trouble because, first of all, they don't have good financial records, and because they haven't kept financial records, they may delay, filing tax returns. And as I said earlier, well, first of all, if you don't have good accounting records, you probably don't know how profitable or unprofitable your business was. But now you're 2-3 years down the road, and you've got significant profits, which you have to pay taxes on, and you don't have the money to pay them. So you definitely want to strongly consider, engaging with accountant at some stage. I'm not saying that it's the right thing for everyone to do right away. It depends on the size of your business, how robust it is, what your revenues are, et cetera. But minimally, even if you doing it yourself, quote unquote, you may want to invest in, accounting software, probably QuickBooks, but make sure you understand that and make sure you use it. Because I have many clients. I said, what type of accounting system are you using? Oh, I have QuickBooks, but I don't really use it. Well, so you don't have an accounting system. Mm-hmm. That's also, so think strongly about aligning yourself with, someone in the accounting profession, not a bookkeeper. I mean, we could also have a bookkeeper, but they serve a specific set of needs that, an accountant or a CPA might not necessarily, that you might need. There may be needs beyond that of a bookkeeper, especially if your business, rises to a certain level.
Mm-hmm. Okay, it looks like we lost Dave. I don't know what happened, unless it's...
Oh, he had a hard stop, huh?
Yeah, no, maybe he had a hard stop at 1 o'clock. So I'm gonna go ahead
buy
and
some crypto.
maybe to go diversify his funds. So I'm gonna go ahead and share his information. So David Carler can be found at davidcarler.nm.com. He's with Northwestern Mutual and offices in Paramus. And he is, he's a supporter of Bergen of North NJ in color. I have to get my own name change correct. And so we just thank you for your time today, James, and we thank Dave as well. And we thank all of you for joining us.
Thanks for having me.
Oh, no problem. We'll probably have you again because I know we have more questions out there. This is something that we need to do pretty often, just because, like I said, these conversations need to be had because there's so many people who we just don't know and we're afraid to ask. And ignorance is not bliss, especially when it comes to money. So when you have questions, just kind of, send them our way. You can email me at publisher@njincolor, or you can send us a DM. We'll do this again and I'll let you guys know when we do this. Maybe next quarter, we'll have either more professionals or different professionals, or we'll figure it out. But this is something that we wanted to do, especially during Financial Literacy Month, just to, inform the community, engage our followers, and just getting a dialogue started. So thank you for joining us today. I really appreciate you spending your lunchtime with us. And thank you for joining us at NJ in Color, where we connect you to the diversity of North Jersey. Have a good afternoon, everybody. Thanks. Take care.
Thank you.
Bye-bye.
Take care. Great program.
Thanks, Jason. Bye.
Bye.